Hello, good evening, everyone. Welcome to all of you for today's session. Students, just let me know whether you people can hear me well. Can you hear me?
Yes, sir.
Good. So, just a minute, I'm starting my lecture.
All right. So, students, we have talked about NPV and adjustments. And yes, in the last class, we have talked about that. Annuity and perpetuity, I think we have to cover. Let me open the last class worksheets. What was done? Yes. On the 17th January, what did we do? So we have done a question on pink company. Yeah, so this was the extra we did actually, because of which we have discussed, okay, NPV IRR. All right. So the today's topic will be, yeah. So annuity and perpetuity, and then risk and uncertainty in the investment appraisal. First of all, annuity and perpetuity. How many of you know about annuity perpetuity? Yeah. Annuity perpetuity. How many of you know? Tell me. Okay, no worries, no worries. That's I'm asking, that you just tell me. How many of you know what is annuity and what is perpetuity? I need response from everyone. Silence is not an option. Silence is not an option. Yes. Tell me remaining people, please. Yes, Arzina is in the class. And Toshni is in the class. Yashoda is in the... Is they are present in the class? They can hear me? I'm just wondering, because I'm not getting any response from them. Yes. Can you hear me? People I have named. Please. Okay. So you should respond. Do you know about annuity perpetuity or not? I'm asking you a question. Yes or no is simple answer. So that's like the answer. People are sending me messages, of course. Yes. Now, so students, what is annuity? What is annuity? Annuity is a series of cash flows. Series of cash flows with constant amount at constant interval for limited period of time. For limited period of time. For limited period of time. Yeah, I will explain it. Limited, which is also called limited or known, which is a known period of time. Series of cash flows with constant amount at constant interval for limited or known period. For example, you will be getting this amount, same amount every year for 4 years, for 10 years, for 50 years, for 100 years, every year. Constant interval, same amount for known period of time. For known period of time. You know the duration for which you will be getting it. This is called annuity. Now, let us proceed further. So, students, how to calculate present? So, annuity is of 3 types. One is called simple annuity. Then is called annuity due or in advance. Then is called delayed or deferred annuity. Delayed or deferred annuity. Now, so simple annuity is that annuity in which case cash flows start in year 1 from next year. So present value is equal to annual cash flow into annuity factor. Into annuity factor. So annuity factor. So annual cash flow is 4,000 into annuity factor. Now annuity factor is given in the annuity table. That is present in the annuity table. Yeah. Annuity table is here. Yes. So students, for example, we say that cost of capital or discount rate that is equal to 10%, for example. So annuity factor at 10% for 4 cash flows, 4 years. So we can, yes, apply discount factor 10% for 4 years, 3.170. 3.170. Once again, 3.170. 10% annuity table. So this is how we can calculate. Okay, right. Now, formula multiplied by this. Here you go. Here you go. Now, so students, next, what we can do? Annuity due or annuity advance, where cash flows start now from year 0. Now, for example, year 0, example is here. Year 0, 1, 2, 3, 4, yes, 0. Sorry. Student, simple annuity is clear? Tell me. Simple annuity is clear? Tell me. All right. So the next is annuity due. Annuity due. What is annuity due? Where cash flow is starting now, year 0. Year 0. So, for example, cost of capital is same, 10%. Student, present value. Let us forget about this. Let us forget about year 0. This is simple annuity. Okay. So for this, we have formula annual cash flow into annuity factor. Right? For simple annuity, we have this formula. For year 0, what is discount factor? Discount factor is always 1. At any rate, discount factor value will be 1. You can check it. At any rate, for year 0, it is not given, by the way. The reason, because everyone know it is started from year 1. Because that will always be 1. So the formula becomes, this one we are adding for year 0 cash flow. This one we are adding for year 0 cash flow. Sorry. Yes. Now, so the formula becomes present value is equal to of cash flows. This. So 4,000 into 1 for year 0. Sorry. Okay. 1 for year 0 plus for remaining cash flows 4-year annuity factor. This one is for year 0 cash flow. That is 3.17, which we used above. 10% rate is the same. For year, yeah, you see here annuity factor. 3.17 for year. So annuity due, where cash flow is starting now, starting from year 0. Next, the next point is delayed or deferred annuity. I hope it is clear as well. Due. If there is a question, you can ask. Any confusion, you can ask. Where cash flows start after year 1 in any year. After year 1. In any year, but not year 1. May start from year 2, may start from year 4, may start from year 10. But they are limited cash flows. Now, so students, example, year 0. For example, 4,000 is starting from here. Year 4. This is a delayed or deferred annuity. If we consider that this is the year 1, 2, 3, and 4. For example, if we consider these are the year 1 and we forget them, right? Now this is simple annuity. For it, annual cash flow into annuity factor. Simple is answer. Then this will be year 0. Answer will fall here. Whatever we calculate, for example, we calculate 4,000. It is 4 year into 3.17. This is the answer falling in year 0 here. But if we see, if we remove this black sheet, black mask, this is year 3. We have to take them to, this answer is falling in year 3. We have to take them to year 0. This one amount, we will multiply it with 3-year discount factor. So now 3-year discount factor equal to this into 1.1 if rate is 10%. This was -3. Now this is the answer here, present value. If we consider simple annuity, answer will fall in 1 year before where the annuity is starting. We have to take this answer to year 0 to calculate present. This answer is in the terms of year 3 value. Now, 3-year discount factor. So the full formula becomes like this. 4,000 into 3.17 into 1.1 raised to power minus 3 because it is falling in year 3. Here you go. It is done. Now, the next point is, student, is it clear now? Tell me. Def in annuity due and delayed and deferred annuity. Is that clear? Okay, so cost of capital is 12%. Give me its present value through annuity. What you will be doing? You will be calculating it and on the paper and take picture and share in the WhatsApp group of class. Be quick. Calculate it, take picture and in the WhatsApp group of class. Be quick. But how you are calculating, I want to see your process. I'm waiting for your answer. Be quick. Yes, please. Be quick. More answers needed. I want answers. I cannot proceed further. This is unacceptable behavior. I'm sorry. Share whatever you have calculated. You are wasting time by not sharing your answers. I want to proceed further, but I need answers from you to check your understanding. No, I need answers. Picture in the WhatsApp group of class. You are not in the class. Tushni, please. I need answer there. Okay. Why you are not there? I think you have not enrolled. That's why you are not there. I think means whatever is the issue, please, if you are not part of WhatsApp group, do drop a text to coordinator at this WhatsApp number. Tell them to add you to WhatsApp +92. Yes. Yeah. Tell them to add you in the WhatsApp group. All right. Thank you for sharing some answers I have received. Thank you. Now, so just see here. I will delete it. Yes. So we are here. So annuity is annual cash flow. This is annuity due 87,500 into 1 plus 5-year annuity factor at 12% rate. Yes, 12%. 5-year, 3.605. 5-year, 12%. 3.605. This is the answer. Now, so the next point is one more question you have to solve for me. That is 0, 1, 2, 3, 4, 5, 6, 7, 8. $9,000. Cost of capital is 11%. Present value through NOT. Be quick. I need answers. Same in the WhatsApp group, please. It is delayed annuity, deferred annuity. I need answers, not silence. I need answers, not silence. If you want to pass the paper, you have to act the way I am telling you. People are not sharing your answers, and this is something demotivating for me. You are sitting in the class and you are not doing what I'm saying. It's not good. If you have any question, any problem, any confusion, do ask. Otherwise, follow what I'm saying. Yes. Now, next. So, don't, if this attitude, you face some problem, then you should blame yourself. 1, 2, 3, 4, 5, 6. 6-year annuity factor at 11%. 6-year annuity factor at 11%. 4.231. Into answer will fall in year 2. 1.11 raised to power -2. This is the answer. Delayed annuity or deferred annuity? Delayed annuity or deferred annuity is here. Now, next. The next point is perpetuity. So annuity, I have taught to you people 3 types of annuity, because if you do not understand annuity, you cannot understand perpetuity. So that's why I was emphasizing this much, that do calculations, have hands-on practice, so that you can understand perpetuity. So perpetuity. What is perpetuity? Perpetuity is a series of cash flows with constant amount at constant interval for unlimited period of time. It is for foreseeable future. Yeah. For the foreseeable future. Now, next point. The next point is example. You will be getting from next year 5,000 every year, and for the foreseeable future you will be getting the same. No limit. Cost of capital is 10%. Now, perpetuity is of 4 types, sorry. Simple perpetuity, same. Same, where cash flow starts year 1. Cash flows start in year 1. So present value is equal to annual cash flow into perpetuity factor. 1/R is called perpetuity factor. 1 over R is called perpetuity factor. 1 over R is called perpetuity factor. Now, so present value is equal to annual cash flow 5,000 into 1 over R 10%. Here we are. Here it is. Here you go. Next. The next point is delayed or deferred. Okay, perpetually due. In advance. Same. Where cash flow starts from now. Or year zero. Starting from here. For the foreseeable future. Yes. Now, if we ignore it, this is simple perpetuity. Same approach of annuity. So, annual cash flow into 1 plus perpetuity factor, 1 over R. 1 plus 1 over R. This is called present value of perpetuity. So 5,000 into 1 plus 1 over R, 10%. One plus 1 over R. Here we are. The next is deferred or delayed perpetuity. Deferred or delayed perpetuity. Okay, for example, 5,000 starting from year 5 and onwards for foreseeable future. So present value, annual cash flow into 1 over R. Simple perpetuity into same discount factor. 1 plus R raised to power minus N. Same discount factor which we were using in the annuity. Same approach. Raised to power minus N, sorry. Raised to power minus N. Discount factor. So 5,000 into 1 over R into 1 plus 0.1, 10%, raised to power minus 4. Minus 4. Just check this calculation. Now, next point. The next point is perpetuity with growth. Perpetuity with growth. With growth. So perpetuity with growth, that cash flows will grow with a constant rate in the foreseeable future. Yes. Example. So how to calculate present value? Present value is that CF1 over R minus G, where CF1 is cash flow in the first year of perpetuity. G, annual growth rate of cash flow. And R is equal to discount rate. Discount rate. Now, next. Let us proceed further. Example. For example, they say you will get from year 1 5,000 and then will grow at 4% per annum later on. Cost of capital is 10%. Calculate present value. Yes. So present value is equal to CF1. What is cash flow in the first year perpetuity? 5,000. Divided by R, 10%, minus 4%, R minus G. R minus G. Here is the answer. Present value of perpetuity with growth. Note it down, this example. Next. The next point is another example. Is it clear so far? Tell me. Is it clear? Tell me. Is it clear so far? Good. Another example. Another example. You have just received 65,000 as annual profit on investment. Example 2. This is example 2. Okay. And it is expected to grow, and annual profit is expected to grow at 8% per annum in the foreseeable future. What is present value of future profit expected if cost of capital is 15%? Note it down, then I will solve it. Then no, you need to be involved, because I'll be asking questions to you people later on. Yes. So just see here. Current profit given. We need cash flow given. We need cash flow or profit in the first year. Next year, we don't have CF1. We need to calculate current profit into next. What will be the next? Growth 8%. 1 plus 8%. This is CF1. This is how it needs to be calculated. Yes. So you see here, it will be solved like this. So this formula becomes basically CF1 is equal to CF naught into 1 plus G. This is how we calculate it. If CF1 is not given, then we have to calculate CF1 is equal to CF naught. CF naught is current cash flow. Cash flow starting before CF naught. Cash flow before start of perpetuity. Yes. So the formula becomes, so present value is equal to CF naught into 1 plus G over R minus G. Yes, over R minus G. Now, so it is done. How to calculate present value? Simple. CF naught, 65,000 into 1 plus 8% over R, 15% minus G, which is 8%. Yes, it is done. Present value of perpetuity with growth. So it is done. So perpetuity with growth and annuity is done. If there is any doubt, any question, you can ask me, please. If it is clear, you can text me that proceed, please. Yes. I want to hear from all of you. Yes. Okay, students. I will take a short break of 7 to 8 minutes. I'll be back, and next topic is, yes. Next topic is, here is the course plan. Yeah. Risk and uncertainty in investment appraisal. This is the topic for today. Very interesting topic it will be. And easy. You will be loving it, everyone. Okay? So see you in 7 to 8 minutes. Refresh yourself and be back. All right, now the next point is risk and uncertainty. What is risk and what is uncertainty? First of all, we will try to understand the difference between the both. We will be trying to understand the difference between the both. Now, so what is the difference? The difference is there are several possible outcomes, means different possibilities that, for example, cash flow may become very good, moderate, poor. All right. Several, same here in the case of uncertainty. Several possible means your unpredictability is there. Yes. Probability can be assigned to different possible outcomes. You can assign, okay, that outcome 1 happen, 30% probability. 2 happen, 40% probability, and so on. Probability cannot be assigned, can't be assigned to, yes, can't be assigned. Hence, this can be quantified and it cannot be quantified. It cannot be quantified, uncertainty. Yes. Now, next. So students, come to the notes. Risk and uncertainty in investment appraisals. Techniques to address risk: probability analysis, simulation model, risk-adjusted discount factor, risk-adjusted payback, which is also called discounted payback. Uncertainty, 2 possibilities. Yes. So let us start with, I will start with the sensitivity analysis. I will start with the sensitivity analysis. Yes. Now, so students, sensitivity analysis, what is it? Yes, sensitivity analysis. Sensitivity analysis, it is basically, we are analyzing uncertainty attached. So it determines that how responsive is NPV of a project towards a change in its specific variable. That is, how much NPV should move? How much percent move to make, how much percent the variable should move to make NPV of the project 0? Note it down. I will explain it. Next, just see here. Sensitivity, how it is measured. NPV of the project, present value of post-tax variable. Sensitivity variable. Yes. For example, let us talk about, I will take assumed data. NPV of a project is 24370. Okay. Assumed data I'm taking. And its expected sales of the projects are, they are 75,000, 95,000, 135,000, and 169,000. These are the expected sales. I will be taking just assumed data. Tax rate is 30%. And discount rate is, or cost of capital, that is 10%. So this data is given. Just to explain sensitivity. So post-tax sale, we will calculate this into 1 minus 30%. Post-tax, 1 minus tax rate, post-tax. Now, simply all post-tax. If you are doing on calculator, you have to calculate each amount by calculator, 1 minus tax rate. You have to do that. If you are doing it in the section A and B, that's why I suggest my students do a lot of practice in the both platforms. You have two challenges, doing the same calculation in the spreadsheet and on the calculator as well. Now, present value at the rate of 10%. This into 1.1 raised to power minus 10% present value at 10%. Yes. Here we are. So present value. To present value of sale after tax sale. After tax or post tax? Here we go. We have this information now. So sensitivity of NPV towards sales or selling price. Same. Both will be solved in the same way. NPV divided by present value of post-tax sales. %9.6%. I'm sorry. Now, how to explain it? Yeah. Now, how to explain it? Sale is inflow. So, if sale present value falls by 9.6%, NPV will become 0. NPV of the project. Yes. Now, so students, let us proceed further. Let us proceed further. Another example. Same project, variable cost, sensitivity towards variable cost. For example, variable cost is, that is 40% of sale. Yes, 40% of sale. Okay. Post-tax variable cost. This into 1 minus tax rate. Post-tax variable cost. Present value of post-tax variable cost. This into 1.1 raised to power minus so present value of post-tax variable cost I have calculated. Yes. Total present value at 10%. Yes, same discount rate I have applied. Now, sensitivity. NPV, sorry, is equal to NPV divided by this. If variable cost present value increases by, variable is outflow, 10%, NPV will become zero. Next, for example, fixed cost is as follows. Yes, I want you to calculate sensitivity of NPV towards fixed cost. Yes. Be quick, please. Calculate. I'll be waiting for your answer. Same NPV, which we were using the previous parts. Same NPV, here it is. I need answers. Please be quick. First of all, post-tax fixed cost. I have used 30% tax rate, same data, into 1 minus 30%. Yes. Present value of post-tax fixed cost. This into 1.1 raised to power minus this. Here we are. So sensitivity is equal to NPV divided by this. This is the answer. No worries, no worries. So how to explain it? What will be the explanation? Can you tell me? Tell me how to explain it. I need explanation. Yes. How to explain it? If fixed cost present value increased by 42.4%, NPV of project will become 0. Yes. So up till now, sensitivity analysis is clear. Tell me, please. Up till now, sensitivity analysis is clear. Now, next point. Sensitivity toward sales volume. How to calculate? For that purpose, we need to calculate contribution. Contribution. What is contribution? Sales minus variable cost. Sales minus variable cost. That is called contribution. Sensitivity towards sales volume. This we calculated for the sales or selling price. Now sales volume contribution. So post-tax contribution. This into 1 minus 30%. Yes. So present value at the rate of 10%. This into 1.1 raised to power minus this. Yes. So next, the next is to present value total. We can calculate present value of post-tax contribution, and now sensitivity. NPV divided by this. Yes. If sales volume falls by 16%, NPV will become 0. Yes. Or sales volume needs to fall by, yeah. Next, The next is another example. Sensitivity towards cost of capital or discount rate. Now, what to do? So I will be using some different data here. Example 2, I will be mentioning here. Example 2, for clarity purpose. Because we need net cash flows. Net cash flows of project. For example, it is 15,000 negative, 15,000 million, 3,750, 39,080, 5,380, and 7,200. For example, these are the net cash flows. So students, we need to calculate IRR. If you are doing in the section A or B, you need to calculate IRR manually with the formula I have taught to you people. But here, IRR from here to here, 12%. For example, cost of capital is 8%. For example, 8%. Now, IRR is the rate. If the cash flows are discounted, that is NPV will become 0. We have learned that. IRR is the rate at which NPV of the project becomes 0. Now, so you see here, sensitivity. IRR is here. It is the return of the total return of the project minus cost of capital is 8% divided by 8%. You know, cost of capital, how much it should increase by to make NPV 0. Yes. How much? It should increase. It should increase by this 40. So cost of capital should increase by 47.4% to make NPV 0 for the product. Yes. How I calculated this? So you see here, I said increase IRR minus cost of capital, increase. Now percentage increase. So percentage of cost of capital. Simple is that. Now, next, What is the next point? The last point regarding sensitivity towards project's life. I will be taking the same example. Project's life. Just see what we need to calculate. We need to calculate discounted payback. Discounted payback is that project in which present initial investment is recovered in terms of present value. What is discounted payback? In which initial investment is recovered in terms of present value. If you have revised the previous two lectures. Yes, please. So present value at the rate of, first of all, present value, 8%. This into 1.08 raised to power minus this. Here we are. So NPV, sorry, no NPV. We need to calculate present value cumulative cash flow because we need to calculate discounted payback. Cumulative cash flow. In year 0, this. Then in year 1, this is recovered present value. Then this is recovered. Then this is recovered. 3-year complete. 3-year complete. Yes. And then 3844, okay, 3845 divided by 5292. 3.73 year. This is discounted payback of project. Now, if project have only this life, what will happen? Only present value of initial investment will be recovered. That's it. NPV 0. So, sensitivity. Total life is 4 right now. 4 year. It is 3.373. This, if reduced, how much it should be reduced? This much it should be reduced. And this is percentage reduction in life to make NPV 0. This is percentage reduction in life of the project to make NPV 0. Next, .8%. So, if life of the project is reduced by 6.8%, NPV will become 0. Now, let us proceed further. If there is any iota of doubt, do let me know before I proceed. Yes. Student, sensitivity analysis, advantages. Okay, let me open the notes instead of typing again and again. Yes, it is simple and has no complicated theory. Yes. Okay. Oh, sorry. Yes. So students, identify which areas are crucial and should be monitored. Now you see here, I think project life is the most crucial so far. 6.8%. That this only small decrease so you see here, the most crucial variable, which one it is? Right now, product life and then selling price or sale. The most crucial. These need to be monitored. 9.6%. So it helps you identify. Now, yes. So how critical some of the forecasts which should be considered? Yes. Now it is management judgment. Now management has to decide what is the possibility of sale decrease. What is the possibility of selling price decrease, product life decrease, or cost increase. But if they decrease by this percent, project will become worthless. But drawbacks, it tells that these are the critical variables. If they decrease by this percent, NP will become 0. But what are the chances of decrease? This is selling price decrease by 9.6%, NP will become 0. But what are the chances of that decrease? It is not giving any answer. Secondly, so hence, it is not optimizing technique. We need to take over decisions over sell. Yes. Now now how to control sales? It is not being, they say if they fall by 9.6% and it will become 0. But how to manage that to prevent that happening? It is not giving any solution. On its basis, you have to make some decision regarding sales. But what decision to be made? How it to be made? No answer. And there might be some factor affecting the sales. Taste change, fashion change. You may not have control. They may change. Okay. Last disadvantage. It is taking each variable one by one and calculating sensitivity of NPV. It is not taking all the variables together and calculating impact of all variable change on NPV. It is not doing that. So taking in isolation each variable, sales separately, cost, variable cost separately, it is not a good idea. It is not a good idea. Yes, it is not a good idea. So next, it is material prices will change independently. Yes, it is unlikely. Example is given. Factors are, variables are interdependent. If, for example, you are considering material price impact on the NPV, but when material price go up, selling price also go up, and the NPV is affected. So it is unable to consider all the variable change impact. Then to counter this issue, another model, simulation model came. What is simulation model? Its calculation is not in your syllabus, only theory. What does it do? It considers all variables in a go. Many times using the same values, all variables change. So it calculates so many range of NPVs, and then a statistical distribution of NPV is drawn. How? You know statistical distribution? Let me share with you. For example, let me explain, what is statistical distribution? Let me try to explain it to you. You see here, this is the, sorry, I'm trying to draw with mouse because this is the statistical distribution. And you calculate mean, how much is this side, how much is this side. Statistical distribution of NPVs is calculated. That this is the expected NPV. Mean, how much chances are there, how much chances are there. Okay, this is what is done by the simulation model. Is it clear? Statistical distribution, pattern, possible variation above and below this average. Is it clear? This one. Tell me. Yes, then. Is it clear? Simulation model. Tell me, please. Not clear? What I have explained so far is not clear. You have not to draw that diagram. Please, in exam. I am just explaining these two lines. You just need to know these two lines. Remember that. In exam, you will not be required to draw that diagram, calculate expected NPVs like this. No. What is simulation? How it works? The different range of NPVs are calculated and they are drawn like this. Yes. Diagram. Yes. Probability. This is the expected NPV. How much variation possible this side, how much possible this side. That's it. Is it clear? Why don't people respond? Tell me. I think I should take a break from the class, 5-7 minutes, so that you people can fresh. Okay, good. Thank you, thank you, thank you, thank you. I'm sorry, I'm sorry. I received messages now. I think there was issue with the Zoom processing of message. I'm sorry. I just received message from everyone. Okay, so now, so the decision to go ahead with the product will be based on the expected return and what is the risk involved. Yes, advantages. Simulation model consider all possible outcomes. Easily understood. Easily understood. I don't trust. It is complex. Time and cost is involved. That may be more than the benefits derived. It has wide applications. How applications are done? That is none of our business. Probability distribution may be difficult. This distribution, which we draw, the bell-shaped curve, it is not easy to formulate. It is tough job. It is done. Now, next. So then the next topic is probability analysis, which is called probability analysis, which is expected value. Yes. Techniques to address risk. Probability analysis. Expected value. What is expected value? Let us try to understand with example. Come here. Students, I'm telling you now, today, you guys will be having test is falling near as well. Most probably by the end of this month, whatever we have covered, you are going to have a test. So start preparing, start revision. I'm telling you in advance. Okay? So yes, that is important. Now, so expected value, probability analysis, it is also called. For example, they say that companies a company is going to launch a project and selling price might be $15 per unit, $25 per unit, and $18 per unit. Probability. %, 25%, and 65%. Sorry, 65%. What is this is selling price? Yes. Sorry. Selling price per unit. What is the expected selling price? Amount into relevant probability. We will multiply. Amount into the relevant, yes. Here we are. This is the expected value. Next, sum of all. So this is the expected selling price. Expected selling price. Next, this is the expected value as well. Expected value. Now, students, another example. Company, okay, come to the notes. Assessment of different probabilities of a number of, yes, it assesses different probabilities and it gives one answer. One answer it gives. So it recognizes that there are several possible outcomes. Several possible. It considers the probability of different outcome and quantifies them. Very good. Quantify means it considers that. Lead, yes. Or directly optimizing that whether this will be the expected value. Now, you should accept it or not. The project expected NPV is like this. Directly, yes or no will be the answer. The next point is disadvantages. Disadvantages. I will be discussing it. Let me first discuss some question on it with you people. Without going through the questions, we cannot do it. Okay. So we will be discussing some questions and then we can come back to the probability. So I'll be opening the exam kit. Just a minute, please. Just 1 minute, please. I have shared with you both kits, right? And we are doing Kaplan. Am I right? Or BPP? Which one we are doing? Tell me, please. I've just forgot. Just keep per mind. Which we started in the last class. Tell me, please. Kaplan or BPP? Tell me, please. If you remember. Or you have memory like me. Yes, BPP we started. Thank you. Thank you. I'll be opening the same. Yes. Yes. Section B type question. It is yes, here we are, page number 71 and question 136. And we have to do it. Yes, this is the question. A company is considering a project with the following cash flows. Okay, now cash inflows, net cash flows, variable costs, initial investment. Okay, cash flows arise from this unit at $10 per unit. Okay, this is sales. Now, the company is at a cost of capital of 9%. The NPV of the product is this. The sensitivity of the project to change in sales volume. Sensitivity of the project towards a change in sales volume. Tax rate is not given, so we have to ignore tax. We have to ignore that. Let me open my iPad because these are OTQs, so that, just a minute, so that we can solve the way you will be solving in exam. Okay. Yes. Now, so students, the point is, what happened? Just 1 second, please. Wait a second. Students, meanwhile, you have kids. You can start calculating the answer, 136. Try to do that. Try to do that, please. Wait a second, much time. 136. Okay, you didn't have it. I will be sharing. I will be sharing. Okay, don't you worry. You are not in the WhatsApp group. Yashoda, I'm sorry, whatever your name is. You are not in the WhatsApp group, or you are already there? I'm asking you, you are in the WhatsApp group? Okay. So I have shared a link over there. I have just transferred this kit to that link. It will be uploaded there as well. Okay, within maximum 10 minutes. Okay, because the file is heavy, it is being uploaded. You can find it there in 10 minutes. Why it is taking this much time? Anyway, it is taking too much time to downloading the iPad. So students, sensitivity to change in sales volume. We need to calculate contribution. Very easy. This is sales minus variable cost. It is already contribution, by the way, 7,100, 7,100. And present value is here. You see here, what is contribution? Year 0, 1, and 2. Yes. 0, 1, and 2. So contribution is sales minus variable cost. 10, this is sales. 10,300. Minus 3,200. Same, both here. So present value of contribution. This into 1.09 raised to power minus 1. 9% is the discount rate, they said. 9%. So present value is here. This plus this. This is the present value of contribution. NPV is already given. So sensitivity, 1490 is the NPV divided by this. (11.9% is the answer. See, 11.9% is the answer. See. Now, the next point is, why? What is the discounted payback? Very easy to calculate. Students, discounted payback, 0, 1, 2. Negative 11,000. You see here, 11,000 investment. Net cash flows are here. $7,100, $7,100. So cash flows, net cash flows, payback, sorry, present value. At the rate of 9%. Equal to this into 1.09 raised to power minus this. Cumulative cash flows. negative this plus this. So 1 year complete. Okay, 1 point, right? So it is 4486 divided by 5976. 1.75 is the answer. So what is the IRR? 15% and 20%, two discount rates. 15% and 20%. Now they have told specific. So you have to calculate it on the paper like this. Yes. So net cash flows. I will show you just a minute. Let me note it down the data first, because this file is not being downloaded on iPad. 15% and 20%. Okay. Just see here. Now, here are the net cash flows. They say calculate IRR using this. So present value. First of all, discount factor at the rate of 15%. Discount factor at the rate of 15%. Yes. Now, so discount factor 0.87. So 1.87, 0.756. Calculate present value and give me NPV at 15%. Be quick, everyone. Be quick. Give me its answer. Give me NPV, please. One student has given me NPV 544.6. Anyone else, please? Okay, good. So now same cash flows, discount rate at the rate of 20%. It is 1.833 and 0.694. Now multiply this with it and calculate present value and give me NPV at 20%. Be quick. Yes, please. NPV at 20%. More answers, please. Anyone will give me the answer, please? NPV at 20%? Anyone, please? Should I solve myself? You are telling me that? Negative 158.3. Just check. Negative. It should be negative. Yes. So we have NPV, one NPV and the second NPV. So IRR, lower rate, plus NPV at lower rate divided by NPV at lower rate minus into minus NPV at higher rate into higher rate minus lower rate. This minus minus will be plus. Give me IRR. Give me answer, please. 18.87%. Okay, so what is the kit thing? 18.9%, exactly, is the answer. 18.9% is the answer. Now, the next is, which of the following is true? 139. Please go through it. Which of the following is true? Yes, please. Read it carefully. The sensitivity of NPV to a change in sales volume. Wrong. It cannot be true. The sensitivity, certainty equivalent approach converts, we have not done. By the way, it is wrong. It is also wrong. Using random number to generate possible value of project variable. Okay. Yes, it is doing standard deviation of expected project outcome. C is the answer. Yes. So this is wrong. D is also wrong. C is correct. It creates, yes. Now, C is the answer. So the next, which two of the following statements are true of the IRR and NPV method of investment appraisal? True. Starting with IRR is superior? No, NPV is superior. Remember, NPV is superior. IRR is not superior method. Oh my God. Just a minute, please. Is not responding. Yes. NPV is widely used in practice. Yes, it is used. NPV is used. Yes. IRR is when non-conventional. Wrong. IRR is not. Because in the case of non-conventional cash flows, what happens? Multiple IRRs are generated if you have revised the lecture. So wrong. IRR ignore the size of, yes, percentage does not tell the size, how much investment, how much return is there. It is percentage answer. A and C is the answer. Now, so students, The next is, here we are. This is regarding capital rationing. We have not done this section yet. Okay. We have not done this section yet. Next part. Just a minute, please. Let me check the question which we have done. Yeah, we can solve this. Question 146 to 150. Tracker company plan to buy a machine costing this, which will last for 4 years and then be sold for 5,000. Net cash flows are here. Depreciation charge straight line basis of assets. Calculate before tax rows. Now it has to be calculated on what? It has to be calculated on a paper. You won't have excess of that over there. So what I'll be doing, I'll be noting down the cash flows in year 0, 1, 2, 3, and 4. 122,000, 143,000, 187,000, and 78,000. Now, machine value is machine initial investment. That is equal to 250,000. Scrap value. That is equal to 5,000. Now, so then before tax rows, the point is we have cash flows. And for rows, what we need? For rows, we need profits. For rows, we need profits. And we know that profits is equal to cash flow minus depreciation. So depreciation, this is straight line basis. So annual depreciation charge. Straight line basis. Initial investment, scrap value. 250,000 minus 5,000 scrap value divided by 4. Life of the project. What is the annual depreciation charge? Now, can you please tell me the answer? Can you please tell me the answer? These simple answers, at least you should tell me. Yes, please. What is the depreciation? 61,250. So depreciation 61,250 profit, right? We can calculate profits. By the way, there is another shortcut as well to do this. $204,250. There is another shortcut as well to do this. I will tell you. 248250. So now, average annual profit. Add R4, divide by 4. Give me answer. Add all 4, divide by 4. Give me answer. One 147,750. By the way, you just see here. We could have calculated in another way. Shortcut way. Just focus. Total depreciation. 250,000 minus 5,000. 245,000. Now sum of all cash flows. Add all cash flows. Yes. 122,000 plus 143,000 plus 187,000 plus 78,000. 530,000 minus 245,000. Divide by 4. Now this is average annual profit. What I have done, I added all 4, the total appreciation, and this. My mistake. Then we had to deduct it. I'm sorry. We had to deduct it. This is wrong. This is wrong. Because we have to calculate profit. So use this approach. I'm crossing it. This is my mistake. I have added it instead of deduction. 530 minus 245,000 divided by 4. So it is 71,250. This is the answer. Average annual profit. I will re-explain. Listen. We actually have to deduct profit minus, you see here, cash flows minus depreciation. And I added here mistakenly. Okay. So if you deduct it,
okay, and you will get the same here as well. So profit is here, average annual profit, average investment. $250,000 initial investment plus scrap value divided by 2. It is how much? 255,000 divided by 2. 127,500. Rows. 71250 divided by 127,500 into 100. %55.88%. the answer. Based on the nearest whole percentage, 56%. Whole percentage, 56% is the rows. %56. Now, next. Students, all the following statements are on rows, true or false? Rows is less than target? No, false. If it is more than the target, rows can be used to compare two mutually exclusive projects. Students, mutually exclusive project, what they are, actually we have not talked about that yet. So actually I wanted to teach you when I thought I'll be discussing capital rationing. So I'm leaving it here. Capital rationing I have to discuss with you. So then I will be talking about, leave it for the time being, okay? So the first one is clear to you people. Now, Raker company can claim tax allowable depreciation on 25% reducing balance. It pays tax and annual rate of it. What amount of tax relief would be received in the time 4 of an NPV calculation? Now, you have to calculate tax saving on capital allowance. Tax saving on capital allowance for year 4. You remember we calculated in the last class? Tax saving on capital allowance? Okay, I will calculate, don't you worry. Come here. Because they said us to calculate tax saving on capital allowance. Let us do it. Let us do it. So, year 1, 2, 3, and 4. Written down value 250,000. They said that they can claim capital allowance 25% reducing balance basis. So capital allowance, first of all, 25%. So 25% of it, how much it will be? 250,000. 250,000 into 0.25, 62,500. Written down value 250,000 minus 62 minus 62,500. It is 187,500 into 0.25, 46875. Now written down value 187,500 minus 46875. 140,625 into 0.25, 35156. And the final year 140,625 minus 35156. It is 105,469 minus scrap value 5,000. It is 100,469. Tax saving on capital allowance in arrears 30%. This is 30%, 1 year in arrear. For it, tax saving will be here 62500 into 0.3, 18,750. 46875 into 0.3. It is 14,062. For this here and for this here, 35156 into 0.3. 10547 This is the tax saving. In year 4, this is what will be the tax relief. Now, this is the answer. So, come to the next. What is the payback of the machine? Payback, very easy to calculate. Now you can calculate at least this year and this month. This is initial investment. These are the net cash flows. Can you calculate payback yourself? Please try. If you face any problem, I am here. Okay. Now the last question. Which two of the following statement about IRR are true? Exactly. It ignores the size of the project. Exactly. It ignores. IRR measures the increase in value? No. Wrong. IRR sometimes gives conflicting rankings. Yes. NPV and IRR. Sometimes conflicting results. Yes, it is true. So this means NPV is suggesting something else, and IRR is suggesting something different. It happens. So then we say NPV is preferred method. So 1 is true and D is true. These two are not true. IRR is not, we calculate at true rate only. No changing can be incorporated. No impact on the value of the company. So it is done. Students, I would suggest to you, please try to do this next question. Yes, this question. This one at home, BRT company, 151 to 155. You can do it. Milane, no. So BRT you try at home. One more, I will give you 1, 2 more, a few more. Yes. Yes. Okay, try this question. 122. 121, 122, 123, and 124. 125. Yes, 125. These 6 questions are 120 to 125. Please, home assignment is question 120 to 125. And that one OTQ BRT company, OTQ. 5 questions with that. This is your home practice for you before next class. In the next class, what I will be doing, I'll be winding up this topic, which I'm doing in the first, I think, 30 minutes. It should take. Or actually, annuity perpetuity has taken too much time today. It should not have taken that much time. So it will be wind up, and I will be talking about capital rationing, equivalent annual cost, lease or buy. And so I'm telling you in advance, we may need to conduct some additional practice sessions because we are discussing everything in very much detail. And we may need additional practice sessions. So would you like to attend additional practice sessions? Tell me, please. Tell me if I conduct. Okay, so thank you for joining me today. We will meet now in the next class next week. I hope you will revise well these 3 lectures. I'm telling you, the test 1 is approaching near. Test 1. Okay, students. Thank you. Take care. Goodbye. Goodbye. Next one. See you next. Please, those who have not enrolled, do get enrolled now. Because from the next week, you won't have access otherwise. I'm telling you in advance. Thank you. Goodbye.